Hello, everyone. Welcome to Wall Street from Main Street podcast. My name is Mo Daoud, along with Jason Dirac. Today's special guest is Fabian Calvo. He's the founder of CalvoForLiberty.com and also founder of US House Note. Fabian, thank you for joining us again.
Thanks for having me, guys. I appreciate it.
Yeah, Mo, and I think that was the Node House US, right?
Right.
And
okay, you guys can redo it.
Yeah. Oh no. I just making sure out there, and for listeners out there, Fabian also ran for Congress. Brief on his bio. He has a very impressive bio. Don't want to spend 5 minutes going into it. Let's get our listeners want his insights in the real estate market. So let me jump in with my first question. Fabian, do you think the real estate market in the U.S. is back in a bubble? If not, what things would we need to see for the market to become a bubble again?
Well, I mean, all markets are bubbles, and they're all inflated by the Fed. So we don't really have real markets anymore. I mean, we haven't had real markets that are not manipulated in the U.S., at least for the last 10 years, many would argue, since the creation of the Fed. But, I mean, real estate right now is being fueled by Bernanke's money printing to the tune of well over $125 billion a month is the estimates I get. I know on record they claim, or their official narrative is 85. People that I talk to all the time say it's much, much higher. And that's what needs to happen in order for them to try to get a housing recovery or try to get, continue to see the stock market up. So it's all manipulation from here on out. Really investors, you just need to know that going in. It doesn't mean you don't invest or you can't make money investing, but you need to know all markets are manipulated. So technically, yeah, we're in a bubble, and when it crashes, it'll be much bigger than the last one.
And that's a good point, Fabian. And I think one of the things about the real estate market here is that the Fed is so convinced about the wealth effect. I mean, they've just spent, over a decade, many millions of dollars having academics and all of the economists in academia and at the Federal Reserve. They've been giving them bribes because the documentary Inside Job talked about this, right, extolling the virtues of the wealth effect and how we need higher asset price inflation. And the name of the game seems to be that asset prices are not allowed to have, free market forces. With that 20% correction, it's not allowed to stay down there for a while because all the people who are holding the assets are all buying the assets with leverage.
I mean, yeah, and it's leverage. It's leverage to infinity, if you will. I mean, when you have major mega banks like Deutsche Bank, for example, giving billion-dollar line of credit to some prominent hedge funds and private equities out there, and they in turn are buying real estate. It's important that the listeners know, Jason and Mo, that 70%, 50 to 75% of every major market in America today, real estate market, is a cash market. The majority of those investors are large institutional buyers or large institutional buyers that are investing via local, more mom-and-pop investors because it's a way that they kind of can get into markets easily and kind of know the scoop on what's happening with those markets. But it's a cash market, and so it's not even interest rate sensitive anymore. A lot of people think, if rates go up, this current bubble will collapse, but it won't, because the truth is that it's a cash game, and you have the Fed and the media and government literally colluding to have prices in real estate continue to rise.
And also, there's a lot of outside buyers from overseas, like China. I know a lot of wealthy Chinese people are coming to the West Coast and buying a lot of properties there. I know you have an office out in the West Coast. Are you seeing that as well?
Yeah, I mean, it's tremendous. I mean, we actually represent a group of high net worth Chinese investors that invest with the Node House. Many of them, it's interesting because you have a lot of Americans who are deeply, deeply concerned about the U.S. economy and all the $17 trillion in debt and all the other problems that we have. And then you have a lot of other foreign investors who, have concerns about their country, so they're putting their money to work in America. It's not just Chinese buyers; it's Canadians, it's Russians. They're buying real estate not just on the West Coast. I mean, they're buying real estate all across the country. Take Detroit, for example. Detroit's a market that's being heavily invested by the Chinese. They're buying up all kinds of real estate in Detroit. But you even have French investors buying in those markets as well. So it's the real estate market now is a global market. Players from all over the world are participating. A lot of those players at some level circle back to, hedge fund groups, private equities that really kind of know what's happening. Well, what do they know that's happening? They know the Fed will do everything until this whole thing collapses. They will keep printing money, keep up with the QE, keep rates at all-time lows in order to have this, in really a last-ditch effort to have this economy recover and the housing market recover. But the bottom line is they know that it won't recover. I think for many of these guys, they know this is the end game. They're looking to make the best of it before we are on to some larger event that makes 2008 really just look like it was just kind of like the first opening act, if you will.
Yeah, and Sprott, to add to your point there, Fabian, about QE being larger than $85 billion a month, I don't know if you caught this, but Eric Sprott wrote a paper on this a couple weeks ago called A Taper in a Teapot, and he was saying that QE for most months, because the Fed is reinvesting, the interest payments from some of their bonds, and some months it's at least $115 billion a month. So that would just add to the strength in your point right there. But in terms of the global capital, I see, there's over $9 trillion outside the United States right now. It's probably a lot more than $9 trillion considering, how much money's been printed off balance sheet, all the global QE, all the currency pegs, and, all the extra money global central banks have printed to counter the Fed's printing to keep their currencies at a fixed exchange rate. So that money, people are, the people with a financial education like yourself, like me and Mo, if we are given that type of money and we could borrow it for free, we're not going to hold on to the money, right? It's going to go into assets. It's going to go into cash flow real estate. It's going to go into large cap dividend stocks and things like that, right?
Yeah, exactly right. And let me just say that, as someone who's basically runs a private equity firm investing in real estate, I obviously look at, and the people on my team look at other global economic factors, the U.S. dollar, all kinds of things in making our investment decisions and deciphering investment criteria and what have you. And I can tell you one of the big things that I think not just my firm, but a lot of other ones that I deal with is that they all understand that this next time around, they're looking for pretty much a currency default by the U.S. or a reset of the global world reserve currency. It's actually something that's been getting a lot of buzz in the last 6 months with people that I talk with. I talk about it often on my YouTube channel. I refer to it as a global economic reset. I know there's others out there as well that are talking about this. But, this is going to be probably one of the most significant events in U.S. history. And you're going to see the U.S., basically the U.S. lose its world reserve currency status, likely to the Chinese. The Chinese are openly marketing to their citizens right now, telling them, to buy gold and silver, that we're going to basically emerge with the new gold-backed currency. So, I think there's much bigger problems than the $17 trillion in debt, and the American people need to know what it means when America loses the world reserve currency.
And it's not like they're going to really default on their debt next week, because they're still going to pay the interest payment on their debt. So I think that there's a lot of misconception going on with the mainstream media that they're really going to stop making payments on their debt, which is really not true.
Yeah, no, Mo, that's a great point, because technically we've already defaulted. They're talking about default like that's, we've already done that. We did it when we went off the gold standard. We defaulted on the gold standard. We've done it most recently when Ben Bernanke swore before Congress he wouldn't monetize the debt, and he's monetizing the debt. We're paying off our creditors with basically printed money in essence, and they recognize it. And so that game's not going to last much longer. So yeah, will they keep making the interest payments? They will, but the question is, what's it going to take, or how much longer until we see, let's say, the Chinese, maybe privately, but perhaps maybe even publicly, tell the U.S., listen, we want to trade these treasuries for maybe some gold you have in Fort Knox, or perhaps some, some oil-rich real estate that you may have, because we don't want your paper anymore. We don't believe it's worth anything. And I think we're coming to a point where, I'm hearing that narrative from investors that have been investing for 40 plus years. And I'm talking people that, have closed door meetings with the Fed, go to meetings where the Fed puts on presentations. And these are major guys that are also voicing the same concerns that I'm talking about. And, I want to applaud the two of you for having this format to educate as many people as possible about, the real crisis at hand.
Thanks, Fabian, for the compliment there. If you've read Currency Wars by Jim Rickards and the financial war game that Rickards talks about in the first couple chapters, the end game is playing out almost exactly like the financial war game scenario that Rickards played when he was on China and Russia's team then in 2009.
Absolutely, and one of the ways that will fight, and by the way, I recommend everyone read the book. It's fantastic. And one of the things that that the way that'll play out is through the media, and you already see the media and the Chinese using media. And look at most recently, you had Vladimir Putin write an op-ed in the New York Times. It was followed by the Iranian president write an op-ed. I mean, you see other heads of state that are now directly appealing to the American public, bypassing the so-called leadership, bypassing the so-called mainstream media. And I think you're going to continue to see that, these direct appeals, and letting them kind of know, where they stand. Another point that I'd like to mention, though, is that, I think for somebody who's listening to this message for the first time, guys, they're obviously alarmed. I get comments and emails literally every single day about people that just woke up to the fact that the U.S. is, the largest debtor nation in the world, in the history of the world, and all the other problems that we have. And they kind of get panicked. The truth is that for educated investors in any asset class, this is going to be one of the best opportunities. And people like Mike Maloney talk about it being one of the greatest transfers of wealth in history. I absolutely agree with that. I think it's a wonderful opportunity. I think that's how people need to look at it. They need to look at it as, how can this benefit myself, my family? How can I secure, be secure for me and for my family? And I think that, this is one of those historical times that people should get ready for.
Now, about real estate and inflation, let's talk about, before we talk about more about real estate and maybe some investing specifics for our listeners who want to learn about real estate investing, let's talk about shadow inventories. Do you think large U.S. banks are still holding a large amount of shadow inventories off the market like they did after the housing bubble first popped in 2007? Or are sorry,
yeah, I mean,
go.
That question gets me so pumped up because, the narrative that inventories are an all-time low, that technically could be true. But again, it's collusion by the big banks, the media, and government that are purposely pushing this narrative that, inventories low because, buyers are in the market. It's totally a crock of bull. Banks right now, as we speak, are sitting on over $1 trillion in distressed debt and in bank-owned properties. I mean, I deal with banks literally every single day. I review their balance sheets because I buy their mortgages, I buy their distressed debt or their distressed properties, and I see them every day. I mean, every bank I look at, 50 million, 80 million in distressed debt. And the reason they're able to just keep it on their books and slowly trickle it out is because the Fed's giving them ultra accommodating policies. I mean, under any normal circumstance, any other business would be bankrupt and they would have to fold because any shareholder would be like, this is insanity. But these banks, and I'm not talking about the big banks, I'm talking about, pretty much every FDIC bank in the U.S. out there. Not all of them, but I'd say a majority still have debt problems stemming from 2008. And furthermore, a lot of them have, off the book balance sheets. They don't report this to the average shareholders. It's off the books, all of this debt that they still have, because it's bailed out by the federal government. So the federal government gives these banks money, in essence, to offset all this toxic debt, but they still have to sell that toxic debt. They still have to sell those properties into the market. One perfect example is Los Angeles. Los Angeles' real estate market, I mean, take a place like Culver City, California. Prices are above pre-level boom. So they've recovered, and now they're above and beyond what they were during the boom. So, but just last week, there was an investment group that came out reporting that inventory in the next month is up 25% over last year. And this is in a market where supposedly inventory is dwindled. But where's all that inventory coming from? It's coming from banks that still have the toxic debt, and they're starting to release this stuff into the market.
And the home builders are still building too. I think eventually those will be a good short again, but not quite yet though.
Home builders are still building because the home building lobby is huge, specifically at the state level. I mean, when I ran for public office, I could tell you the home building lobby is so huge, you guys, and they get so much money, and there's so many government programs. I mean, for example, reported in those statistics are a lot of tax credit properties. So the government, in essence, are making these sweetheart deals with builders to build whether apartment complexes or housing that's basically so-called affordable housing. In fact, recently, HUD came out with a new agenda to basically kind of re-urbanize, if you will, the suburbs or in other urban areas. And a lot of that is basically money that's going to go in grants and loans and what have you. It's going to go to builders to build. So that's what you see fueling housing. A lot of it has to do with basically in some way getting government, getting some of this phony printed money in order to build those homes.
Yeah, Fabian, I saw, I read a book. It was by John Allison. He was the former CEO of BB&T, if you're familiar with him. And in the book, he blamed the Community Reinvestment Act under President Clinton for fueling the housing bubble. Do you agree with him?
Well, I agree with that, and it was actually started under Carter, expanded under Clinton. I do agree with that, but in essence, that's basically saying that they force banks to make loans to basically low credit or non-credit worthy borrowers. So is that true? Absolutely. But what's even more true is that the subprime was under $1 trillion. Loans made to credit-worthy borrowers in new investment vehicles that were created, like, basically a teaser rate for 2 years, what have you, those were over $1.4 trillion, far exceeding subprime. How many of those loans estimated to default or defaulted? About 75%. That was to credit-worthy borrowers. So it's not just, you really can't just put it on subprime people that bought homes they couldn't afford. Was that a component of it? Absolutely. But it was also credit-worthy borrowers.
Well, the credit-worthy borrower now, Fabian, and I've spoken with other investment professionals like David McElvany, if you've listened to our podcast on that, and he's like people with great credit scores now. A lot of them who are ready for retirement, they don't even have $60,000, and that's considered pretty good now for most Americans. So it's just really sad at the state, that the United States has become to. But that's because, Keynesian economics and all the other incorrect signals that the market, this central planned interventionist market has put forth. People don't want to start their own business. They don't want to save. Most people want to consume first before they produce, and, that's putting the cart before the horse.
Yeah, I couldn't agree with you more. We have, again, as I started out the discussion, gentlemen, was that every market is now manipulated. And I want to just drive this point home because this is something that, I basically tell everyone. And again, I preface it with it's a wonderful opportunity both before and after this crash. I mean, look, when the big crash comes, it's going to be a great opportunity. Leading up to the crash, it's a great opportunity. But you got to really know what it is that you're dealing with. And what you're dealing with is you have the Federal Reserve clearly, in my opinion, knows this is the end game. It's the last hurrah. It's what von Mises talked about as the crack-up boom, which basically, they just keep printing the money. Interest prices continue to rise until eventually there's an event that takes place, and there's a much larger collapse that involves the U.S. dollar, but also involves multiple bubbles bursting. I mean, there's a lot of mainstream economists talking about this. It's the dollar bubble, the student loan bubble, the government debt bubble, the housing bubble, the stock bubble, you name it. And all of those center around dollar-denominated assets. So when the dollar goes down, all of those assets will go down with it. And it's going to be pretty significant, guys.
Yes, and with every just every crisis is an opportunity, and so I wanted to take you to the next subject, and that's the city of Detroit and their real estate market, which is pretty much dead right now because there's a lot of abandoned neighborhoods and a lot of abandoned homes out there. So as a real estate investor, I wanted to ask you and get your opinion about what's going on in Detroit. Do you think there's a chance for that area to come alive again in the real estate market?
I'll tell you, Mo, with respect to the real estate market in Detroit, I mean, literally, in the last 6 months, I think my firm's bought and sold about 600 houses in Detroit. Detroit is absolutely a war zone. There's no question about it. I mean, you drive neighborhoods, it literally looks like you're in some kind of war-torn area, you know, in Serbia or in, you know, the Middle East. The bottom line is that investors from all over the world are buying homes in Detroit because a home that to build would cost you a couple $100,000, you could buy it for a couple $1,000. So, you know, it's actually a wonderful market for investors that know what's going on and can buy these properties and resell them. I think there's a lot of people all around the world that are betting that there's going to be some kind of recovery. I can tell you after Detroit filed bankruptcy, every real estate agent that I deal with in that city told me that they were getting literally hundreds of phone calls. And I deal with some of the top agents in that market that basically all they do is sell distressed real estate. They were literally getting hundreds of calls from investors all around the world wanting to buy properties because they think, look, if I buy a home for $5,000, I can't go wrong, regardless of what happens. And, you know, only time will tell if that's right or wrong. You know, we'll see ultimately what happens with the restructuring and everything else. But ultimately, you know, the state still has a huge debt load of pension debt that it won't be able to pay off. They will likely default on that. And, you know, and also they have a real bad population problem. I mean, you know, in 1950, Detroit was the largest city in America. It had 2.2 million people. Today they have 700,000 people. And so that's a big problem. You know, quite frankly, I think it's an area the reason the Chinese are investing in there so much is because they're going to be making a play at one point to take over a lot of the manufacturing plants that you have there that are basically, if you think of like a fixer-upper house, think about a fixer-upper manufacturing plant. I think that's how the Chinese are looking at it.
And Detroit was also, Fabian, not only as large a city as you said, but it was also one of the richest cities because they were manufacturing and there wasn't that much government intervention. People worked hard. They produced more than they consumed. They saved the difference. They try to invest. And then, you know, people just got complacent, and the government there kept raising taxes every year, more central planning, more directives, more rules, more regulations, more taxes on this and this and this. And what once was their tremendous advantage is now a burden. And, you know, you have all of these government all their problems are basically almost all centrally planning and government related.
Yeah, it's really the epitome of central planners' wet dream gone totally wrong. I mean, starting from the model cities of Lyndon Johnson, you know, there's been a liberal Democrat as mayor of that city since the 1960s. And, you know, look, the bottom line is in 1950, again, we had 13 million manufacturing jobs in America. You know, last year we had 12 million manufacturing jobs in America. Keep in mind the population has over doubled since that period of time. So we're losing manufacturing. Detroit's taking a major hit. Obviously, it was a city built on manufacturing. And, you know, unless there's a huge manufacturing revival, either by the Chinese in America or by America in America, you know, that city's going to continue to have serious challenges moving forward.
So following up with the city of Detroit, if you look at other cities in America that's going down the same path as Detroit, L.A., Baltimore, I think Chicago is in the same boat as well. Are you also looking at the real estate market in other cities as well, or just focusing on Detroit?
Yeah, no, we're in 30 metro markets right now across the country, for everywhere in different markets in Florida, I mean, Kentucky, Alabama, so all over the Southeast, Northern California. So we're pretty in a lot of different markets, and across all those markets, we're seeing asset prices rising. They're rising as cash investors are buying the properties at an unprecedented rate. And so inventory is being suppressed purposely by banks, working with different, as I mentioned a little bit earlier, governments helping them suppress that inventory. And then you have the media helping out as well. So, the markets you just mentioned, or some of the states that you just mentioned as well, like let's say California, all of these have the same thing in common with Detroit. They all have a tremendous amount of a pension system that's pretty much bankrupt. I mean, look at the bond rating for California. It's the same as Kazakhstan's for the love of Pete. So, I mean, that ultimately ends really badly for all these different states that have massive pension funds that they can't pay. They're only going to be able to pay by issuing phony bonds that people will buy, but eventually people won't buy those either. So, that will have a direct effect on the real estate market. But that's I think a few years down the road. I think in the interim, short-term horizon, I'm basically in and out of different real estate transactions, really on a daily basis, and I think that's where investors should focus on short-term in and out deals that can participate in.
Now, Fabian, one of the shorter-term real estate investments is tax lien certificates and tax deeds, and it seems like municipalities and state governments in many parts of the U.S. raise property taxes every year, no matter what, because they want to increase their government spending budget. Do you think these tax lien certificates and tax deeds would be potentially good investment in the future in these areas, as many property owners struggle to pay those increasing property taxes, and people could walk away with the property for just paying the tax?
Yeah, I mean, listen, that is a opportunity. There's no doubt about it. People need to understand, though, that when you buy a tax deed, there are at times resale restrictions with being able to deliver a clear title. And so it's not the same as buying a titled property. That's something that's normally not discussed when people are talking or tax liens. Every state is different. Every county is different. So you have to kind of check what's going on with that. There's so much distressed inventory out there that you may be buying a tax for a property that nobody even wants to buy. So yeah, you may be able to buy it for $500 or a couple $100, but I mean, you'll be able to sell it for a couple $100. So it just kind of depends. Most mortgaged property would be, most mortgage properties, the lenders will not allow the property to basically default because of a tax lien. The lender will likely pay the property taxes on something like that in order to save the property. It's basically usually it's pretty much policy for most major banks, and pretty much any bank for that matter. So you really got to know what's going on, and it's different in every county. So people really got to get educated on it.
So it's like going from the top down and researching a market and then a stock and an individual company and their sector and what type of competitive advantage. Then it requires a lot of due diligence.
Yeah, I mean, what I advise any real estate investor, whether just starting out or new, because one of the beauties about real estate investing, I know this gets a lot of people kind of think this isn't true, or they think it sounds like a late night infomercial. It is the only asset class that somebody can monetize with no money out of pocket and no credit. I mean, the no credit thing, you don't need credit necessarily to buy stocks. Although you go to open up a, Charles Schwab account, they're gonna want a credit, basically check your credit. But nonetheless, it is the only asset class that lends itself to that. And that being said, that presents a pretty good opportunity for the average person to, educate a market. Find out what neighborhoods have a lot of distressed debt, find potential investors that may be interested, and you can get involved and you can start making some money. But it all centers around the most important thing is education, knowing your market better than anybody else. If you know the market better than anybody else, and this is something anybody, Mo or Jason, can learn, then you have the competitive advantage.
That's a great point, and that's the same that goes to any type of investing, whether it's real estate or stock market. Because invest in something that you understand. You shouldn't invest in something that you don't understand. I think that's one of the principles of investing from Warren Buffett. That he only invests in things that he understands. So the same goes to real estate.
Yeah, that's a great point.
Yeah. So one final question I have for you, and that's regarding to a lot of people on Main Street, and they're trying to figure out if it's better to buy a home or rent in this type of economic environment. And there's a lot of uncertainty out there regarding buying a home because we're hearing a lot of stuff about Congress taking away the tax breaks for buying a home. They're raising states raising property taxes, more regulation, more fees, etc. And if you look at the numbers out there, only 55% of Americans own a home, which is the lowest it's been in 18 years. Do you think Americans are better off buying a home or renting in this type of environment right now?
Yeah, that's that's somebody's personal decision. My belief on that is that if you find a home that if you're just starting a family, let's say, and you find a great home that is a home that you're going to live in for 20 years, then then go ahead and buy the house, and get a 3% loan, because that interest rate's not going to be around for much longer, or should I say, won't be around for the next years, I think. So that's that. I think that if you can, continue to rent, and you don't necessarily need a homestead, you don't need to, then absolutely. I mean, look, this notion that your house is the biggest investment of your life, or that a house is an asset, is a totally fictional. A house is a liability. Know that going into it. But again, some people want to have that security of living in a place for the next 10, 20 years, and you're only going to do that through home ownership.
Yeah, I would personally rather rent and then take that money because most people now have to put down 20%. In order to get that 30-year mortgage, you're going to have to put 20% equity down for most Americans anyway. Although you said for many properties, it's like all cash from foreigners. But if instead of putting down that 20% equity, I'd rather put that into maybe rental property or stocks, dividend stocks, or technology stocks, or commodities, or something or physical metals, or something along those lines, than put it in my own mortgage in my own house at this point.
Yeah, I think that's a very good point, Jason. I think it really comes down to, and like I said earlier, any investor being educated on what they're doing, because, I hear from people all the time, that bought silver at $40, or, at $50, or when it was close to $50, and, now they're all complaining because it's, low 20s. And here again, they don't really understand the fundamentals of why you buy silver and gold. They think you buy it to for it to go up in price, and I guess some people would. I buy it as an insurance policy against a failing dollar because I know the dollar is going to collapse, and that's why historically people would buy gold and silver. They would buy it as a hedge against fiat currency. Ultimately it all settles back down to gold and silver. So whether it's housing, whether it's stocks, or any of the other asset classes or investment vehicles you just cited, people need to get educated. That's the beauty of the information age, is that anybody can get educated relatively quickly. I mean, if you think about it, some of the different books that you've mentioned, whether it's Jim Rickards or the guy from BB&T, here's people who've had a lifetime of experience condensed into a 200-page book that you could read in 3 or 4 days and now have their experience as well. So that's what I urge everybody to do, especially during these times.
And I completely agree with that, Fabian. And I have one last question here, and this is like a big picture question about the real estate market and the U.S. government. Why do you think it has been government policy since FDR to try to get Americans to own a home and to, put out a mortgage and stuff like that?
Because it's a major component of the economy. If you look at all of the different factors that surround real estate, I mean, you have Home Depot, for example, major companies that surround, that basically are profiting off of home ownership, whether it's title companies, attorneys, mortgage lenders. But the reason they've pushed home ownership is because banks can make mortgages and make money. I mean, that's the bottom line. The first 10 years or 12 years of a loan for people is interest payments only. And so that's why we're encouraging refinancing, because the banks make out like bandits. I mean, if you bought a home 5 years ago, all you've done is pay interest for 5 years. Now you're going to refinance, and now you're going to pay interest for another 10 to 12 years before you've even made one principal payment. So That's the driving factor. It's enriched the banking cartels tremendously.
And that's a great point. Fabian, I'd like to thank you for coming back on for Wall Street from Main Street podcast. People want to find out more about your work. Where can they go?
They can go to the notehouse.us or they can go to fabianforliberty.com. I post commentary and videos on both of those channels. And if they're interested in more in the housing market, they can find that information at the notehouse.us as well.
Great. Well, thank you. We enjoyed the discussion on the real estate market, and hopefully you can come back again down the road.
Yeah, anytime, gentlemen. I appreciate it.